All right, let's talk about Apple. Right now, all the headlines seem to be screaming that the company's in decline. But behind the scenes, some of the world's smartest investors are doing the exact opposite. They're betting big. So what on earth do they see that the rest of us might be missing? Let's dive into the contrarian case for one of the biggest companies on the planet.
You know, Apple just hit its 50th birthday. You'd think they'd be popping the champagne, but instead, it feels like they're weathering a perfect storm. The stock is lagging, regulators are breathing down their neck, and in this massive AI race, everyone's accusing them of being left in the dust. So the big question is this just a bad quarter, or is the golden age of Apple actually over?
So first up, let's play devil's advocate. To really get why some people think Apple's best days are behind it, we need to look at the very same charts that are probably keeping some bearish investors up at night.
I mean, this chart tells a pretty simple but kind of worrying story, doesn't it? While the broader market, the S&P 500, has been climbing, Apple has been going the other way, dropping around 8% so far this year. For a giant that's supposed to lead the market, not drag it down, that's a huge red flag.
Now, for the traders out there, the folks who live and breathe these charts, this pattern is basically a giant flashing red light. It's called a double top, and it's a classic warning sign that things could be heading south. It suggests the stock tried to push higher, failed, tried again, and failed again. And the fear now is that the path of least resistance is down.
So what is a double top exactly? Well, think of it like trying to climb a mountain that has two peaks. The stock price climbs up to a high, then it dips. It tries to climb back to that same high again, but it just can't break through. When it then falls below the valley between those two peaks, chart analysts see that as a really strong signal that the momentum is shifted and the price could be in for a real slide.
But just when you think the case is closed, that the bears are right, bam, you get this quote from the Oracle of Omaha himself, Warren Buffett. After selling some of his shares, he basically came out and said he regretted it. And get this, even after that sale, Apple is still the single biggest investment for his company, Berkshire Hathaway. So that just begs the question, what does Buffett see that the charts don't?
Well, the answer, in true Buffett style, starts with the fundamentals. I mean, forget the day-to-day stock chart for a minute, and let's look under the hood. Apple isn't just a company, it's a financial fortress that's practically built on a mountain of cash. Let's just start right at the top. In one single quarter, Apple pulled in nearly $144 billion in revenue. That's a 16% jump from the year before. For a company this massive, that's not just growth. It's like a freight train accelerating. But, making a ton of money is one thing. Keeping it is another. And this is where Apple is just in a league of its own. A gross margin of over 47% means they keep almost half of every single dollar that comes in. That's a level of profitability that most companies, especially hardware companies, can only dream about.
And all of this culminates in one really powerful metric. The Piotrowski F-score is like a financial stress test, okay? It has 9 different boxes to check. Apple gets a perfect 9 out of 9. It's like they entered a financial decathlon and didn't just compete, they took home the gold in every single event.
So what does that perfect score really mean? Well, the F-score looks at everything. Profitability, how much debt the company has, its cash flow, how efficient it is. Getting a 9 basically tells an investor that the company's financial foundation isn't just solid, it's pretty much bulletproof.
Okay, so their bank account is rock solid, but the money is only part of the story. The second pillar of the bull case is something you can't really see on a balance sheet, but it's arguably even more powerful. It's ecosystem.
$2.5 billion, with a B. Just let that number sink in for a second. There are more than 2.5 billion active Apple devices out there in the world right now. That's not a customer base. It's basically a digital nation. And it's the foundation of one of the most powerful competitive advantages in business history.
And that massive user base is exactly what creates Apple's famous economic moat. That giant defensive wall that keeps competitors from even getting close. It's built from 3 really powerful things. The sheer pain of switching to something else, the magnetic pull of its network, and a brand that's so strong it's almost a religion for some people.
So what are we actually talking about here? Well, high switching costs. That's the factor. Just think about losing all your iMessage history or having to move all your photos and files from iCloud. It's a huge pain. And network effects? That just means the whole system gets better the more people use it. More users means more app developers, which means better apps, which brings in even more users. It's this amazing self-feeding cycle.
Okay, so the money's there, the ecosystem is a fortress.
But let's tackle the elephant in the room, right? The biggest knock against Apple today is that they are totally behind on AI. But what if they're not behind at all? What if they're just playing chess while everyone else is playing checkers? So on one side, you have pretty much every other big tech company just pouring billions of dollars into building these enormous, energy-guzzling AI models in the cloud. Apple? They're doing something completely different, and frankly, a lot smarter. They're letting others do the super heavy lifting through partnerships while they focus on making AI that's efficient and lives right on your phone, keeping your data private.
The secret sauce behind all of this is a technique called model distillation. The easiest way to think about it is like this. There's a giant teacher AI in the cloud that does all the really hard learning. Then, it teaches a much smaller, nimbler student model everything it knows. And that student model is tiny enough to run directly on your iPhone, giving you all that AI power without sending your personal data anywhere or killing your battery. It's pretty genius.
And that right there reveals Apple's real endgame. It was never about building the biggest, baddest AI. It's about owning the distribution. Apple wants to be the ultimate middleman, using Siri to connect its 2.5 billion users to all kinds of different AI services, and, of course, taking a nice, profitable cut along the way.
Okay, so that's the theory. That's the contrarian case. But how does that actually translate into a potential trade? Let's break down the specific game plan that our source analysis lays out, including the key price levels to watch for, buying, selling, and, really importantly, managing your risk.
So based on the source material, here's one possible way to structure this. The analysis points to an optimal buy zone between $238 and $246, basically a range where the stock has found support before. It also lays out a shorter-term sell target and, crucially, a hard stop loss at $225. Now, obviously, this isn't financial advice, right? It's just a look at how a disciplined investor might think through a trade based on this specific thesis. But hey, let's be real. No investment is a sure thing. So to give a balanced view, we have to talk about the serious risks that could totally blow up this whole bull case.
And really, it boils down to three major threats hanging over their head. First, regulators all over the world are taking aim at the control Apple has over its App Store. Second, its deep connection to manufacturing in China is both a huge strength and a massive geopolitical risk. And finally, there's the age-old question, can Apple keep making hardware that's so good people feel like they just have to upgrade every couple of years?
And that really brings us to the final thought here. The negative headlines, the scary-looking charts, they're all real. You can't ignore them. But then you have these rock-solid financials, this locked-in ecosystem, and a really clever, almost sneaky AI strategy that the market might be completely missing. So the ultimate question you have to ask yourself as an investor is this. Is the market just mistaking a temporary storm for a permanent change in the weather?